welcome to the Explainer. You ever get that feeling that you're doing everything right? You're saving, you're investing, but you're just not getting ahead? Well, today we're going to talk about one of the biggest, silent reasons why, the slow, steady erosion of your money's value. We're going to break down exactly how to hedge your portfolio against a falling currency, which is, let's be honest, an absolutely critical skill for any serious investor.
All right, here's our game plan. First, we're going to get a grip on the problem itself. What is purchasing risk and why does our money lose value in the first place? Then we're going to open up the toolbox. We'll look at non-correlating assets, inverse instruments, options, and then we'll finish with a master skill, delta hedging. Let's dive right in.
So first things first, let's talk about a risk that hits every single one of us, whether you have a massive portfolio or just a simple savings account. It's called purchasing risk, and you can think of it like an invisible tax that's constantly eating away at your wealth, even when you can't see it.
I mean, this question right here, this gets to the absolute heart of the problem. It's not about the number of dollars you have. It's about what those dollars can actually do for you. What can they buy? That's the only thing that really matters.
Okay, so what are we really talking about here? Purchasing risk is simply the danger that your money is going to be worth less tomorrow than it is today. Not in terms of numbers, but in terms of real-world stuff. Will that $20 bill in your wallet still buy you lunch in 5 years, or will it only get you a cup of coffee? That's purchasing risk.
And this example just makes it painfully clear. Imagine you saved $1 back when gas was $1 a gallon. Awesome, you could buy a whole gallon of gas. Well, that dollar is still $1 today. The number hasn't changed. But if gas is now $10, your dollar only gets you 1/10 of a gallon. Your money lost 90% of its gas buying power. That, right there, is purchasing risk in action.
So why does this even happen? I mean, it's not like it's an accident, right? There are real specific economic forces at work here. So let's get into the mechanics behind why your currency might be losing its punch.
A huge part of the puzzle is a policy you've probably heard thrown around a lot: quantitative easing, or just QE. Put simply, this is when a central bank, like the Fed here in the US, starts pumping brand new money into the financial system. The goal is to make it easier for people to borrow and hopefully to stimulate the economy.
And a key part of this process is something called monetizing the debt. Sounds complicated, but the idea is pretty straightforward. The government needs money, so it issues bonds, which are basically just IOUs. Then the central bank comes along and buys those bonds with, you guessed it, newly created money. So a government IOU is effectively turned into cold, hard cash that floods into the economy. And this is the crucial takeaway. It all comes down to basic supply and demand. If you suddenly have way more dollars floating around, but you don't have more stuff to buy, more cars, more houses, more food, what happens? You get a whole lot more money chasing the exact same amount of goods. And when that happens, the value of each one of those dollars has to go down. It just buys less. And hey, you don't have to take my word for it. Just look at the data. This chart is showing a US dollar ETF. That's a fund that basically tracks the dollar's strength against other big world currencies. And what do you see? It's a pretty clear downtrend, isn't it? That's a real-world loss of value. That's your purchasing risk right there on the screen. Okay, so enough about the problem. We get it. Our money is losing value. The real question is, what can we do about it? Let's crack open our risk management toolbox and look at some practical tools. We're going to start with the most intuitive one, holding assets that don't just sink when the currency does.
I want you to picture a teeter-totter, from the playground. That's the goal here. We want to find assets that act like the other side of that teeter-totter. So when the US dollar goes down on one side, these other assets have a natural tendency to go up on the other. That creates a built-in natural hedge for your portfolio.
So what kind of assets are we talking about? Well, you've got your classics, like gold and silver. For thousands of years, people have run to precious metals when they lose faith in paper money. Then you have the modern version, cryptocurrencies like Bitcoin. Because they're decentralized, some people see them as a hedge. And of course, there are real physical commodities, things like corn or oil, things the world actually needs, which tend to hold their value when a currency is getting weaker.
All right, let's kick it up a notch. While owning things like gold is a great foundational, sort of passive defense, what if you want to go on the offense? That's where inverse instruments come in. These are tools designed to be a direct counterattack when the market or the currency starts to fall.
Now, this is going to sound a little crazy, right? Diversification is dangerous? We're always told to diversify. But here's the catch. If all your diversified stocks and bonds are priced in a currency that's getting crushed, you're still losing purchasing power across the board. It's like carefully rearranging the deck chairs on the Titanic. You're busy, but it's not going to help.
And this slide just nails the difference. Think of diversification like a flu shot. It's great for protecting you against one specific thing, like one of your stocks going to zero. But hedging? That's your homeowner's insurance. That's for the big systemic disaster, like your whole house burning down, or the entire market taking a nosedive.
And that's exactly where these inverse instruments come into play. An inverse ETF, for example, is literally designed to do the opposite of a market index. So, if the S&P 500 drops by 1%, the goal of its inverse ETF is to go up by 1%. It gives you a direct offsetting gain to cushion the blow from a falling market.
Okay, time to move on to a more sophisticated tool. But I don't want you to think of this as some wild speculation. I want you to think about this as buying a direct insurance policy for your portfolio. This is how the pros manage their risk with real precision.
So what the heck is an options contract? It's way simpler than it sounds. It's just like car insurance. You pay a small fee, your premium, for the right to have the insurance company cover your car if you get in a wreck. You're not obligated to crash your car, you just have the right to protection. An options contract is the same. You pay a small premium for the right, but not the obligation to sell your stocks at a locked-in price, protecting you if the market crashes.
So how do you actually use this insurance? A really common strategy is buying something called protective puts. A put option gives you the right to sell something at a certain price. So if you buy puts on a broad market ETF, like the SPY, which tracks the S&P 500, you are literally buying an insurance policy on the entire market. If the market tanks, the value of your put options goes way up, and that helps offset the losses in the rest of your portfolio.
And that brings us to our final tool. This is the master skill. This is an advanced technique that professional traders use to grab control of a losing trade and stop the bleeding right in its tracks. It's called delta hedging.
Okay, let's just walk through this nice and slow. It's not as scary as it sounds. Step 1, you have to admit a trade is going against you. Then you analyze its risk, which is called its delta. Step 2, you calculate that delta. Let's say it's negative 0.26. That just means for every dollar the underlying stock goes up, your position loses 26 cents. So step 3 is simple. You neutralize it. You create a new position with a positive 0.26 delta. Now your net position is neutral. The losses stop.
And this is maybe the most important thing to get about delta hedging. The goal isn't to magically turn a losing trade into a winning one. That's not what this is for. The goal is to stop the bleeding. It's financial triage. You're hitting the pause button on your losses, which gives you time to breathe, to think, and to figure out your next move without the pressure of losing more money every second. You're mitigating the damage and taking back control. So let's pull it all together. Let's look at the toolbox we've just built. The absolute core principle, the foundation of everything, is proper position sizing. Don't bet the farm on any one thing. From there, you layer on your foundational hedges like gold, then your counteroffensive tools like inverse ETFs. For more advanced insurance, you have options, and for true precision, the master skill of delta hedging. But none of it works without the golden rule. You always have to have an exit strategy.
And that really leaves us with a final thought. Look, you and I, we can't control what central banks do. We can't control global economic storms, but we can absolutely control how we prepare for them. We can build a financial lifeboat. So the real question is, what's in your plan? What tools are you putting in place to make sure you can ride out whatever storm comes your way?